Chapter 6 Value at Risk. Value at risk, VAR for short, is a measure of the risk of investments. In this chapter, we will first introduce the relevant basics of VAR and then examine the major valuation approaches, including delta normal methods and simulation methods. Finally, we will also study risk mapping for reducing the dimension of the correlation matrix involved in the valuation of VAR. Now let's start with the first section, VAR basics. VAR is an attempt to provide a single number for senior management summarizing the total risk in a portfolio of financial assets. It has become widely used in the financial industry in recent years. Central bank regulators use VAR as prescribed in Basel I, Basel II, and Basel III Accords to determine the capital a bank must hold in order to reflect the risks the bank is bearing. Those risks include market risk, credit risk, and operational risk. For more details, please refer to the following website. Generally speaking, VAR is part of a statement to describe or quantify the risk of a portfolio. Such statements could be as follows. We are X% confident that we will not lose more than V dollars in the next N days. Here, the X% refers to the confidence level, and the V dollars is the VAR, and the N days is the risk horizon. More formally, VAR is the maximum loss that will not be exceeded with a given probability during the risk horizon. Here, the probability can be regarded as a confidence level. Or, VAR is the worst loss over risk horizon such that there is a low prescribed probability that the actual loss will be larger. And in this sense, the probability is the significance level. This graph illustrates a portfolio profit and loss distribution for 95% confidence level with the VAR marked at the left tail. Define C as the confidence level, then the significance level is 1 minus C. Let L denote the loss, measured as a positive number. Then VAR is the smallest loss in absolute value such that the probability of L greater than VAR is less than or equal to 1 minus C. For example, if for a 1-week horizon, a portfolio is said to have a VAR of $1 million with C equal to 0.99, then this implies that the probability of experiencing a loss greater than $1 million within the week is 1% or less. From the previous description, we can see there are 3 basic VAR parameters. First, the risk horizon, denoted by H, is the future time interval over which VAR is measured. It could be 1 day, 1 week, 1 month, 1 quarter, or 1 year, etc. Second, the confidence level, denoted by C. This means the probability of losing more than VAR is 1 minus C or less. The possible choices of C could be 90%, 95%, 99%, and 99.9%, etc. And the last parameter is the base currency. Typically, both H and C are included in the reference to our VAR measure, in the format of H, C, and VAR. For example, a 1-day 99% VAR of $5 million for a certain portfolio. Under Basel II Accord, the market risk charge for a bank is calculated based on the VAR, with a risk horizon of 10 trading days, 99% confidence level, and an observation period for at least 1 year with at least quarterly updates. The general market risk charge is the higher of the previous day's VAR, or the average VAR over the last 60 business days, times a multiplicative factor k, with floor value of 3 adjustable upwards. There are two approaches to model or estimate VAR, namely the non-parametric approach and the parametric approach. We will talk about the details in the next lesson.